And thank you for inviting me to the conference.
Pleasure
being here, and very interesting sessions in the beginning. So I'm going to mainly talk about the outlook for the UK economy. So it's going to be a bit broad, but hopefully it can drive lessons for the procurement industry. So in terms of what is the outlook for the UK in 2023, yesterday the International Monetary Fund said that the UK is going to be the only G7 economy that's likely to contract in 2023, whereas other advanced economies are likely to grow. Unfortunately, we very much agree with that assessment. We do have a forecast for a recession in the UK throughout 2023. Mostly, it's going to be likely to be a 4-quarter recession, with sort of GDP falling by around 1% throughout this recession. Given historical context, it's actually quite a shallow recession. So that's sort of the good news, that it's going to be not as big or as disruptive as the recessions that we've seen in the 1990s or in 2008 or during the pandemic. So it's likely to be a shallow recession. But one of the things to note is that, firstly, that the UK has not, in some sense, even recovered back from its pre-COVID levels. So we've seen a big lockdown, and then we've seen a recovery, but the recovery has not been enough to get us back to our pre-COVID level of GDP. So there's still a long way to go, and the fact that we're going to have actually output contract in the next few months means that this recovery back to pre-COVID level is actually a bit delayed. So now, what are the sort of reasons why we are sort of calling for a recession in the UK? The UK consumer is facing one of the most historic real income shocks that they've seen. This is a slide where we have kind of gone through the real income declines and increases over the last few years. And, in the 70s, obviously, inflation was extremely high, and everyone spoke about a real income shock then. But the difference was that actually at that time, wage growth was actually quite strong as well. So it kept in line with inflation, and people's real incomes actually did not squeeze as much. They did, but not as much. However, in the last 2 years, in 2022 and 2023, we are forecasting real incomes to fall by 2% each year, so a cumulative 4% drop in real incomes for consumers. And that's mainly coming from the fact that, obviously, we've discussed a lot about how inflation has been a big driver of why people's incomes have been squeezed. But the other big thing that has obviously happened at the same time is that the Bank of England has had to raise interest rates for consumers, which has basically meant that a lot of us are now spending a lot of money paying our mortgages, and that is obviously reducing the amount of money that is left to spend on other things. So this sort of historic real income shock is sort of one of the big reasons for this recession. The other thing also, I think there are some structural factors that are taking place in the UK as well. We've clearly had Brexit, which has meant that some of our supply chain, some of our trade barriers that were there with the European Union, they have become more complicated, which has potentially increased costs for businesses which are trading with the European Union. And this chart, is something that, if you look at sort of business investment in the UK, that has actually underperformed quite a lot compared to what the pre-pandemic trend was. So we are about 20% below what the pre-pandemic trend was in terms of business investment as a result of some of these headwinds and structural factors that the UK is facing. Now, obviously not everything is bad news. There has been some sort of positives that have happened in the last 1 month or so, which actually can mean that actually the recession is not as deep as expected. One of the things has been actually there's been the big decline in energy prices, right? So energy prices were driving a large part of the story and large part of the consumer pessimism as well as the business pessimism over the last few months since the war in Ukraine. And since January, we've actually seen about a 50% decline in energy prices because of the fact that European supplies, Europe's winter has been sort of, and UK's winter has been doesn't feel like it today, but in December was sort of milder than what we were forecasting. And also, Europe has been actually quite resilient in terms of building their energy supplies, and storage and gas storage across Europe has been much stronger than what people were expecting. So obviously, when the invasion happened, everyone was quite doom and gloom about the fact that Europe's going to run out of gas and there's going to be power cuts, etc. in the UK, etc. And none of those downside scenarios have materialized, which basically means that if this energy price drop is sustained, it basically reduces the real income shock going into the second half of the year. The second important thing that's happened is that China's reopening. I mean, obviously the impact of China reopening on the UK particularly is not that big, but in general, in terms of global supply chains coming back online, which already was happening over the last few months, but that process of disinflation in goods happening more quickly is definitely another positive for the UK economy. Now, inflation, obviously we've sort of talked a lot about it. I'm going to quickly go through what the main message there is. We've actually seen a peak, in our view, in headline inflation. We think inflation peaked at 11% in October, and we're going to see a decline in the next few months. And this is going to be faster if the energy prices drop more quickly. But it's something that we are sort of forecasting for the next few months. The main thing, the things that are driving this decline is the fact that energy prices are coming down, but also, core goods inflation, which drove a large part of inflation in the later half of 21 and early 2022, has been coming down. So supply chains were quite stretched, and there was a big, as we all know, there was a big increase in demand for goods when people came out of the pandemic. We were all buying laptops and exercise bikes in order to sort of, pass our time. So there was a lot of demand of goods, and there was a big supply issue. And over time, those two have converged, where supply is coming back online, whereas demand for consumer goods has actually reduced over the last few months as people's real incomes are squeezed. So, goods is one big factor, a place where people are cutting back on spending in order to sort of because of their affordability concerns. So in terms of inflation, the two drivers that would get it down is energy as well as core goods. The thing that we are most worried about is actually services inflation, or the wage inflation. That is probably going to keep inflation quite sticky in the near term, which is why we are not forecasting inflation to come back all the way down to the Bank of England's 2% target. And you can see that in the sort of these inflation expectation mechanism, where you ask firms, what do you expect inflation to be next year? It's still at 7.4. 3-year inflation is still at 4, which is double what the target is. So this kind of psyche, where inflation gets a bit embedded in the psyche of people, where companies feel that they can pass on costs and prices and increase prices, as well as employers can feel that they can ask for wage rises as well to compensate for the cost of living. That creates a bit of a spiral. I wouldn't say go back and say it's as bad as what it was in the 1970s, but there is definitely an element of stickiness of inflation in the UK, especially more so in the UK, that we're seeing compared to some of the other advanced economies. And we can see that inflation in this. I mean, this is kind of making the point that I was just making. What actually is driving inflation? And I think we talked about being quite aware of what is driving inflation. And in the past, it started as a core goods, which is the green bar line, and then it became an energy shock, and now it's quite broadly distributed between core goods, services, inflation, as well as energy and food. So it's become quite broad, and in services, inflation is the one that's fairly sticky. And I think a large part of this labor market issue is mainly coming from the fact that actually, the UK has seen one of the biggest drops in workforce participation during the pandemic. During the pandemic, a large number of people left the workforce for many reasons across the world. In the US, mainly because a lot of mothers had to go, and take care of their kids while schools were shut. And a lot of those people are now coming back into the workforce, whereas in the UK, the issue is that a lot of this drop in participation was driven by people in the 55 to 65 age category. And the reasons they have given is long-term sickness, it's retirement. So these are the two big factors that are driving people leaving the labor force. Now, it's the government is doing a big, it's a big puzzle for the Bank of England, for the government, about why these people are not coming back. Is it to do with the state of the NHS, or because a lot of things were postponed during COVID, but long-term sickness has come out as one of the big reasons why people have left the workforce, which has basically mean that the UK economy has seen major labor shortages, and as a result, because even though demand is weakening a little bit for labor, people are still being able to ask for wage rises, or companies need to offer wage rises in order to get workers to be employed in the company. So there is a big, there's a big sort of labor shortage problem in the UK, which makes UK inflation, in my view, a bit more persistent. And you can see that in sort of the wage growth figures, which are now at close to 7% in the private sector. Clearly, there's a big difference between what the public sector is earning and the private sector, which I guess explains the strikes that we are seeing. This is the biggest gap we're seeing between public and private sector wage growth in the UK currently. So this is sort of clearly one of the big reasons why we sort of expect, the Bank of England to keep rates high. We're expecting them to increase interest rates tomorrow. We're expecting them to go up to 4.5% by sort of the mid of this year. But the more importantly than that, I think interest rate cuts, which a lot of people are talking about, are still, despite the recession, I think we are not there yet, because it's a very unique situation for the Bank of England, where even though growth is weak, inflation still continues to be extremely high and sticky. So it puts a big trade-off for the Bank of England. And just given the fact that we've end up seeing inflation sticky for a while, we think that the Bank of England is unlikely to cut interest rates, and we're going to have interest rates staying high at around 4.5% through the rest of the year. But the good news for this, the only last chart I want to know, in the interest of time, the last chart I want to show is on supply chain. I think this is sort of our global colleagues have done this sort of heat map when we sort of look at different indicators of supply chain stress that we are seeing in the macroeconomic data, and which include things like supply delivery times, as well as shipping costs for different companies. And we obviously saw a lot of reds in sort of early 2020 and mid 2021, where we had a big supply chain problem, which was what was driving a large part of why core goods was so expensive in the UK as well as globally. But thankfully, there's some stuff green in the last few months, which basically means that some of these supply pressures are easing in the economy. So overall, it's a bit of a, I'm sorry I can't give a more positive spin to the economy, but I think the good news is that the recession is likely to be shallow. And the other important thing is that we're actually also not forecasting a big rise in unemployment. So given these sort of labor shortages and labor hoarding, it's probably going to be a job-rich recession, if you can call it that. So unlike previous recessions where you end up seeing a big rise in unemployment and lots of job losses, I think this one is going to be fairly shallow and one which avoids a large number of job losses, which could be the positive message I would want to leave with. I can stop here.
Thank you very much. Sorry. It's really hard to forecast the economy.
Yes.
Of course it is, all right? So if you had to make a bet whether you've been too cautious or too optimistic or pessimistic, which way do you think the sort of risk profile lies?
No, actually, to be fair, I think we've been too pessimistic. In the last few months, we've actually seen the economy be more resilient than a lot of people were forecasting. And I think that's because we are having these two contradictory things at the same time. You have, obviously, this massive real income shock, but at the same time, you have people whose jobs are secure. You've had people who have built a large number of savings during the pandemic, so they could potentially, maybe smooth the real income shock by using some of these savings. So actually, the energy situation has not turned out to be as bad or as doomsday as people were expecting when Russia first invaded Ukraine. So I think in the last few months, I think data has surprised us to the upside, and hopefully the recession is actually maybe shallower than even we're expecting now, or we don't get one. So I think we'll be more on risks are to the upside.
So because of the danger, otherwise we'll start being optimistic, and that would be a bad thing. So if I just take other downside risks for a second, your data on the investment in the UK has basically plummeted. I think that was the gist of that. I mean, have you got some sense of how the contributory factors to that and whether that is likely to reverse? because you could make a case at the moment, if you look at the news today, you'd say we have increased unionization, we have, which restrains labor mobility, we have house prices remaining high, which restrains labor mobility, we have Brexit, which makes immigration harder, so restricting labor mobility. That all leads to inflation, for example.
Yeah.
So, I mean, are you doom-laden about the UK PLC on 2030 lens?
No, I mean, I think on the business investment side, one of the things is that, obviously we're going through an adjustment process where in the past, a lot of the business investment in the UK was linked to supply chains which were directly, linked to the European Union. So we have this chart where we had, companies which have a big share of their value added going to Europe, and how much investment goes into those those companies. So I think the UK model, because the supply chains over the last 30 years has been so smooth with the European Union, the UK model has been built on investing in a lot of those companies. Now, obviously, there's been a shift now, and those companies might not find it profitable anymore to be trading as smoothly with the European Union. And I think because of that, there is a bit of a gap that needs to be basically filled. And I think, we need to have fiscal policy. I think what's happened with the turmoil of the mini budget, where so much focus went on trying to regain credibility after the Liz Truss fiasco, was that you needed that a lot of the things that are good for the structural long term of the economy, which is things like investing in infrastructure in different parts of the country, or skills and immigration, those things got put to the back burner, and the focus was just on trying to get regain credibility in the market. So I think those things need to come back. So I think if there's the right policy put in place and there's some time given to kind of find what can substitute all the investment that went into the European supply chains, you need to find other things that we can think about and invest in.
So your proposition is the government will make some strategic investment decisions. Okay, that seems optimistic. Do we have? I'm not quite clear where John is.
John is on.
He's now visible. Great. I can now see you. Great. Everybody else can see you too. John, do you have anything that you want? I mean, I know you're going to do your piece and put the Cranfield lens, and it's a privilege. We've had you over the last few years as chief economist as well. So, how would you want to build on what Sonali's articulated?
So first of all, I think Sonali's given an excellent overview of where we are in terms of the UK economy. I would agree with the projections on growth into the end of this year. People are talking about anything between 0.5% and 1%. Your last point there about whether the risk is on the upside or the downside, I would say that bumping along the bottom is what we're doing at the moment. So, and remember this notion, I've said it to the conference many times before, that economists talk in decimal points to show that they've got a sense of humour. So the idea that we can be that detailed about where we think the economy is going to go is probably pushing it a little. I think the projection about inflation is important. I think we're going to be around, the suggestion is around 4.5% at the end of this year. So we're not going to, as Sonali said, we're not going to get back below that 2% level that the Bank of England is charged with managing inflation at. I think the problem that we've got at the moment is that the inflation in the system is primarily cost inflation. And so we have a real issue here between what is causing inflation and the policy response. So the policy response is to increase interest rates, but you primarily increase interest rates to try and reduce demand in the economy, but it's not a demand inflation. So we have then, Joe Stiglitz, the Nobel laureate, wrote a beautiful piece in The Guardian at the weekend where he said it's an inappropriate policy response to the inflation that we've got. So the danger is that we have excessive increases in interest rates, partly due to the Liz Truss fiasco. Sonali, your words, not mine. Okay, where the government and the Bank of England and UK as an economy generally is having to buy back credibility by showing it can manage itself effectively. And I would argue we're probably paying a premium in terms of interest rates because of that. So I think interest rates are probably a little bit too high. That will keep the economy bumping along for too long at the bottom. I think all of the issues that Sonali indicated that are causing inflation to remain sticky are are correct. I think we have to be very, very clear about a kind of rhetoric that is appearing in the media, which is trying to suggest that we're back. And it was interesting, Sonali talking about the 70s and 80s from the perspective of history, whilst one or two of us can actually remember being there. The wage price inflation that we saw in the 70s and 80s, which was due to unions being particularly strong and forcing those wage increases, is not what we're seeing now. It was interesting that Sonali spoke about 7% increase in private sector wages. And this is the fact that we have shortages of labour supply. We don't have unemployment in a recession, and the private sector is having to bid wages up to retain labour. It is not being forced to increase wages against its wishes because of militant trade unionism. So that kind of narrative that we're seeing in the press about militancy and trade unionism, I don't think is actually driving the stickiness of inflation. It's more to do with the public sector having had real wage cuts. Sonali, the only thing I would say, you talked about a 2-year time frame. I would extend that to closer to 15-year time frame, and we're seeing the impact of that over time. The only thing that I would then add to what Sonali said is when we look at the supply chain issues, and we particularly look at, I'm in Singapore at the moment with my favorite logistics company. I won't mention them, but some of you will know who they are. What they're talking about is sea freight volumes collapsing. Okay, so the amount of volumes that are being traded, both trans-Pacific, so China into the west coast of the United States, into Europe, and then intra-Asia as well. We're seeing those volumes going down. We're seeing the sea freight rates falling at incredibly fast rates. So rates that were in the $10,000 to $15,000 are now down around $1,500 to $2,000. Port congestion is now back to pre-pandemic levels. So we're starting to see greater supply chain fluidity in exactly the way that Sonali talked about. But we've also got an issue now in terms of stocks. And it was interesting listening to your previous talkers, your previous session. Essentially now what we're going from in supply chains is back to just in time from just in case. Okay, so we've seen significant overstocking, I would argue, in the UK, Europe and North America. Our distribution centres are full. In the worst case, we're seeing stocks being held at the port and organisations essentially using ports as warehouses and paying significant retention fees in order to do that, incurring significant costs. We're going to see those stocks wash through the system, I would argue, in Q1, Q2, okay? And then our supply chains will become fluid again. China will open up, so we'll get that manufacturing capability back into supply chains. How people manage risk in terms of their attitude to what's happened over the last 2 or 3 years and going back to longer supply chains will be an interesting thing to see. But the other thing then which I'm seeing anecdotal evidence of is something that's happening with reshoring, where we're seeing Chinese manufacturers coming closer to the point of supply. So definitely the work that I'm doing in North America, we're seeing significant Chinese manufacturing location in the maquiladoras in northern Mexico with a view to supplying into North America, and there's evidence of that happening in Europe. Going back to the geopolitics, we've obviously got the war in Ukraine that we'd like to see resolved. I think the other big geopolitical risk is tension in the South China Sea. As I said, I'm in Singapore at the moment. We've been discussing that over the last couple of days. and the consensus seems to be that they're not as worried about it as maybe some of the press that we've received in the West. And then finally, the impact of the pandemic on supply chains, and I think Sonali talked about this very eloquently. We'll move away from logistics, confusion, chaos towards labour supply. So it will be labour supply which will cause issues in managing our supply chains rather than the confusion that we've seen over the last few years due to the pandemic.
John, thank you very much for that. That was great. I don't know if others have got questions. I mean, I've got a very obvious, to my mind, very obvious quick question to the pair of you. As having two gurus available for us to listen to, quantitative easing basically funded the government's borrowing from 2009 onwards. Okay, quantitative easing is over. Isn't that case for basically that now that it's over, the government's borrowing's going to have to get funded? That means interest rates have only got one direction to go, which is up.
Yeah. No, I mean, I think very interesting because, you know, the UK is the first central bank which is actually experimenting with selling gilts, right? So they're shrinking the balance sheet, but not only by stopping reinvestment, but actually actively selling gilts. But I think one of the things that they have said repeatedly is that they do not want to use this as an active policy tool to increase interest rates. The bank rate is the active tool, and because they have pre-announced how much they're going to sell, and they sell it in extremely normal conditions in the market when there is not that much volatility, and they have a lot of flexibility. We saw that they can stop quantitative tightening when we did have yields go up quite a lot after the mini budget. So I think there's a lot of flexibility in the way they're doing QT. So I think there is pressure. I agree with you that overall, conceptually, there's a lot of pressure. And if you think about it, obviously supply of bonds is going to increase, demand for bonds are going to fall. So clearly, yields are going to go up. But I think the fact that A, the market is quite aware of both the supply and demand dynamics, and B, the Bank of England can stop if things get too volatile, makes me worry less about the yield rise coming from quantitative tightening. I think the yield movements are going to be determined completely by how sticky inflation is, how far the Bank of England needs to go, and whether they will have scope to reduce interest rates in the next few years.
So you're optimistic the government can fund its borrowing requirement without interest rates going up prohibitively?
Yeah.
John, do you have anything to add to that or disagree?
No, I wouldn't disagree with that at all. I think that's an entirely correct reading of the situation. But I think the whole relationship between QE and inflation has to be re-examined. If we go back to our textbooks and we say we've had massive QE and massive increase in the money supply, people say, well, where was the inflation, John? That should have caused enormous inflation in our system given the quantity of QE. But what we're ignoring is it actually caused inflation, but asset price inflation, and which has caused massive disparities in wealth. But that's another issue for another day.
With that moment, we're now just at 11:14, so I think it's time for your tea break. Now afterwards, I think we've discussed before, there are 3 streams for you to participate in, so please take full advantage of those. I said if you want to join some of the roundtables, I still understand that there are some opportunities to join those. But before you disappear off, one thing I would like you to do is join me in thanking our 2 fabulous speakers.